SPY this morning is having a very strong reaction to a revision in hourly earnings, which is still rising, but had a revision. So revisions to, so first of all, unemployment rate dropped 3.7 to 3.5%, right? That's the enemy right now of Fed's mandate to kill consumption and all that. Increase unemployment to 5%. We're at 3.5%. But revisions to average hourly earnings data paint a marginally less worrisome picture for the Fed, says Nick Tamaros. Then the November report, the upturn in wage growth in November, originally reported as 0.6, was revised down to 0.4, and that spun the indices right around very sharply. Those lovely algos love the word revision, just like they love the word truce yesterday when Russia declared truce for their Christmas. So we'll see if this sticks for the market. But I mentioned yesterday that there is, and by this 4.6% annual wage growth in December was the lowest since August 2021. All right. So this is the initially reported, and then this is with the latest revision. So that helps explain a little bit how that little morning burst of enthusiasm came in. And remember, anytime you get this bad news economically, like unemployment, wages are getting revised lower, the algos pick that up as, oh, goody, the Fed's going to pivot pause. I still think they're incredibly trapped, and I don't think that's really the baseline bet until we have something dramatic happen, big unemployment spike and or a big market swoon. But for right now, this is the initial market reaction, taking bears once again and putting them into fetal position on short duration anyway. And yesterday it was the bulls were in fetal position. So we're basically getting lots and lots of turns overnight and pre-market and intraday. And the volatility still is just causing us to go sideways. That's it. Big swath of 3,800. So many piled into. Okay, ISM non-manufacturing PMI still contracting. 49.6, expecting 55. This is ISM services gauge with a lot of wage inflation, shrinked for the first time since May of 2022. So they're going to like that. That's the gist of it. Durable goods orders down 2.1%. That was expected. Factory orders down 1.8%. That was more than expected. Last time it was a positive 1%. And ISM into contraction territory, 49.6. They expected 55. Last time it was 56.5. So basically that is, in a nutshell, a very strong labor market that we continue to see against a weakening economy is just not good. So with that, yields taking a dump below 3.67. So basically bonds like it, right? A little bit more than they did yesterday. And calls came in pretty quickly for 103. So we really need to get above this 103.75. And we really are not through the week yet, but getting back down and below 3.6, this will help the 10 and 21 to roll over. We'll see if that happens. How's the dollar reacting? Not much. SPY likes that print with bonds for the most part, but not really winning any awards. Funny, the terminal rate just dipped a little bit below 5% after the ISM data came out. So market stabilizing. SPY is back up on that ISM data. They liked it. It held 281 and moves higher. With yields pulling back, dollar pulling back. VIX, we finally filled that intraday. That was the intraday. And then we've just bounced here, 2158. Well, I still don't see anything bullish of conviction yet. We had a nice open for the week and we've taken it out and come all the way back down. So not a lot. Let's see if I can get a level. Yeah. It's not really great. All we've done is come right back to do this gap fill. Do you remember this gap fill from Thursday? That didn't fill the gap. This has. So intraday, we just have a gap fill. That's it. So that should be a little support for later, but there's nothing here that looks particularly bullish in VIX. So they're trying to run this higher, and they do have the back or the tailwind of lower dollar, right? That's helping the market bulls, the lower yields, lower VIX, and then we got ISM disappointing. So that's bad news is good news. They're going to try and bring this back up to 38.50. Wouldn't be surprised if we make an attempt at 38.71 again. Dollar is the big reason for the season in commodities, strongly. 38.50 for SPY. We just gained $5 in the Qs practically, and yields dumped. Bonds like that weaker ISM, and the dollar rejected at 105, 106 area and is now looking more likely to come down here and tag. That's what my baseline bet. SPX, wouldn't be surprised if we, 38.50's assumed, right? There's just tremendous chop going on here. 38.50, 38.50, 38.50, call wall, all that. It moves up to 3,900, but I'm just looking at this 38.70. Still, we tagged it, broke, bounced. We're just really just correcting sideways in time, not price. This is still rolling over. This is still very bearish, but we could reverse higher if and when we get above this junk, which is that 38.78 area. We're not there yet. We're just still going sideways. What was it? We were down 1%. And then we moved very strongly 1% higher. And then we moved lower again 1%. And now we're moving back up 1%. So the moves are being, the volatility is all taking place on very short duration. Lots and lots and lots and lots of short duration choppiness. One of these moves, one way or the other, higher or lower, it's coming. No question. Volatility, again, not a headwind. Dollar weak, yields dumping. We got a spike higher, absolutely spike higher in markets today. Oh, yeah. We'll see how we close, but I mentioned already, I expect this 38.71 today. We're on our way. Dollar is dumping, and I've got a level lower. Remember that 102 area? Could get there in a hurry and spike us very, very sharply higher.